Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. Greetings and welcome to the podcast, Richard. I've been really looking forward to speaking to you for a while now.
Well, me too, Bilal. Very good to talk to you.
And first of all, I mean, the reason I have been really keen to get you on was because I read your book, Simple But Not Easy. It first came out, I think, in 2007-8, and you've updated it, at least certain sections of it. I think it was last year, and I read the updated book.
Yeah. The first one came out in 2007, so before the events of 2008, and the second one I think it came out in December, although really I sort of finished it in July last year.
Yeah. And we'll come back to talking about the process of writing a book. I'm a massive sort of book lover. I'm always intrigued by people who have the effort and the willingness and the stamina to write a book. So we'll come back to that at some point. But before we do that, I did want to ask you about your origin story. I always like to ask my guests this. So it'd be good to hear in your own words, what did you study at university? Was it inevitable you would end up in the world of finance and investing? And, what are some of the key milestones along the way until now?
Sure. Well, I did history at university. I didn't do economics, although that's not completely truthful. I did economics for one term. There was that huge yellow book, I don't know if you remember it, by David Lipsey.
Yeah, I remember that book.
Just before term began, my second term began, I set myself down to read the whole of this sort of 2,000-page book. And I got to about page 50 and thought, I can't face it, and rang up and asked to change to history. So my economics, I'm not an economist. The little I know about economics has been learnt on the job. But my origins in investment, I mean, it certainly wasn't inevitable that I was going to end up in investment, but I had been nerdily interested in investment from a very young age. From the age of about 13, I started looking at share prices in the Daily Telegraph. And of course, I didn't know what they meant at all, but I was attracted from a very early age to low prices. And that, in a way, has remained true throughout my career, because although there's a difference between simply a low share price and a value investment, there's obviously some sort of connection between the two. And that was my instinct from the very first.
And then what was your first job? Was it at a bank, at a fund management company?
I joined Warburg's in September 1977, and they had a 2-year graduate trainee program. You set off around the bank, but after about 6 weeks, I found myself in the investment department, and I should have stayed there for a month or 2 months, whatever. But they asked me to stay in the international investment department, which at the time was tiny, and so I did. And I really sort of never left it. I stayed there ever since. And I had, as I say, I was nerdily interested in investment from a very early age. My first investment was in something called Britannia Arrow, which was it was the healthy rump of the Slater Walker empire, which you won't remember because you're much too young to remember, but you'll know Slater Walker went bust in the secondary banking crisis in the early 70s. But there were some decent parts to the conglomerate, and they included the insurance company, which then changed its name to Britannia Arrow. And I was attracted to that company because its share price was 6p. And I remember thinking, well, it could go to 18p, or the worst that could happen is it could go to nothing. So as I say, I had this kind of instinctive attraction to things which look very cheap, very dangerous, of course. But anyway.
And in that specific case, you said it could go to 18p. Was that 18p based on an analysis of the balance sheet or valuations of some kind?
That's an incredibly flattering suggestion. It absolutely was not. I had no idea about how to value a company, how to look at a balance sheet, how to look at a P&L account. I didn't know what a PE ratio was. I knew the only thing I did know was what a dividend yield was, I guess. But no, it was the pure sort of arithmetic that a low number can go to a high number more quickly than a high number can go to double or triple.
Yeah. And then over your career, you've worked for some very large asset management companies, and then also you've run your own money as well. What's the difference between the two, would you say?
Well, I worked for actually one large asset management company, which was Warburg's turned into Mercury Asset Management. which then turned into it turned into Merrill Lynch and turned into BlackRock. But by that stage,
okay, I got confused looking at your background. I didn't realize Warburg's became Mercury.
Yes,
because I remember Mercury
Warburg's,
in my younger days, but not the preceding company.
Warburg's, the merchant bank, owned in due course 75% of Mercury, and then sold it off in 1996 to Merrill Lynch. But I'd gone by then. I went in April 96, and I then joined a family office and ran a family office. And then 9 years after that, I formed my own company. So I've had 3 jobs, really.
Okay.
And what's the difference? Well, there is a very big difference. And the big difference was between the big company and then the 2 subsequent companies, which have been very small. I mean, first, in the entirely kind of superficial way that you learn how to find where the paper clips are yourself and that type of thing. But I do think there's an enormous difference from an investment point of view between big companies and small companies. Big companies, and Mercury was a wonderful place to learn the business and practice the business for 19 years, I was there. But they do become big organizations where there is an awful lot of admin. There is the drive, if it's a quoted company, to push up assets and revenues every quarter or every half year. There are large committees. The decision making gets much less sharp. And by contrast, in a small company, you have relatively little admin. It can be entirely investment led. And the decision making can be extremely simple. I've always been suspicious of too much process, and at a big company, you get completely submerged in process, where one committee has to recommend to another, and there may be some approved list, all that kind of thing. And so I do think small companies are much better positioned to do a good job for investors than big companies. One of the sort of ramifications of a big company back in those days, and I think it's probably still true now, is that you own a large proportion of the market. Mercury owned a large proportion of the UK market. Its biggest client group was UK pension funds, who had a large proportion in the UK, and that makes you relatively immobile, and that means that you start to hug the index, and I think that the fact of bigness, which tends towards index hugging, and also the discovery of what became called active risk, but had started life being called tracking error. I think those 2 things meant that there was a progression towards index hugging. And I've always been allergic to index hugging. I think that if you're an investment manager or an investor, the one thing you should do is try, and index huggers are not trying. And so that again is a big difference. It means a small company is able to be committed, to have a committed, concentrated portfolio in a way in which a big company finds much more difficult.
And on the point, you mentioned process, and that's something obviously large organizations end up having a lot of process. At the same time, though, asset allocators and consultants, when they look at a fund manager, they like to hear about process because it makes them feel more confident that it's replicable rather than just relying on a person per se. So there's almost this encouragement of systematizing, making everything more for process to somehow show that it's a machine, money-making machine,
yes,
or anything else.
And that's the problem, because it isn't a machine. It is dependent on decisions taken by individuals. Of course, you do have to have a process. You have to have a method. What worries me is when you can draw a flow chart which shows a whole row of boxes with arrows between each pair of boxes. And at the very end is the decision. Because by the time you've got through all those rows of committees and decision-making bodies and so forth, and recommendations and sifting out, by the time you get to the very end, I think you've got a tremendous tendency towards mediocrity. I'm sorry about my dogs.
That's okay. I've got a dog and cats, so it's fine. Now, in terms of equities themselves, of course, equities in recent years have done quite well. In fact, actually, since the early 80s, they've done really, really well. But before that, there was long stretches in the 70s where it didn't do so well. We have Japan after the bubble economy burst, it didn't do so well. And so, Richard, on equities themselves, obviously in recent years, in fact, recent decades, equities have generally done quite well, but there have been stretches where they haven't done so well over the 70s. And then there's some markets like the Japanese markets, which have struggled. So, and so why have this faith in equities? And you talk about this in your book as well. I mean, is it that we've just had this golden period and it's a fluke in some way, and equities aren't really as good as it kind of looks? I mean, why do you have this faith in equities?
First of all, I don't think it's a kind of arithmetic fluke, and I think that is illustrated by looking at the very long-term returns. People like Credit Suisse and probably your old place, JP Morgan, have gone back to what they call the beginning, and I think the beginning is sometime in the early 1800s. So what kind of indices they had in those days, I don't know. But they've looked at the return of equities since that sort of time. And there's an astonishingly sort of comforting graph produced by one of those banks, which shows the long-term, the trend return. And it's just astonishingly a straight line. Of course, there are blips in it where you fall below the long-term trend return. But even 1929 to 33 appears as a tiny little blip in this otherwise extraordinarily consistent pattern. So arithmetically, I think it is not a fluke. Now, it is still only one history, and it could be that the single history dating back to 1829 in the light of eternity is a fluke. But it's the longer you go, it's the more unlikely it becomes. So I think it's not an arithmetic fluke empirically looking at what has happened in history to date. Why should it be so? What's the theory of why should equities give a good return? I think because there is a tendency towards GDP growth and productivity growth, which do, of course, they get interrupted from time to time, and then you have a bleak period. But on the whole, human ingenuity and population growth hitherto have been such that there is GDP growth and there is productivity growth. There are technological improvements which provide for productivity growth. And so I think that gives the justification for equities providing a real return. And then again, empirically, what kind of real return? Well, that trend return that I referred to is pretty consistent across markets. In the US, it's the highest. I think its average is still about 6.2% real return after inflation. In the UK, it's something like 5.1% after inflation. Now, there are exceptions. You picked out one. Japan has given a real, I don't know what its very long-term real return is. It is a positive number, but it's been pretty sick for a very long time. Argentina, somewhere like that, would be a major exception. Russia, in pre-revolution Russia, would be a major exception. And that argues for diversification across markets. But all the same, broadly, internationally, nearly every market has given a healthy real return. Might not be 6.2% in the future. Maybe it's 2 to 3%. It's still a better real return than you can get from most assets. And so that's the reason that I've got this faith in equities. I think that chart is the sort of thing that an equity investor needs to have under his or her pillow at night to remind them of why they're in the game. And then, of course, then you have the question, well, if that's the case, and it's only so for the long-term investor, because as you say, you can have very bleak periods which last for a surprisingly long time. But if you are truly a long-term investor, it's an incredibly privileged position to be able to have a lot in equities and then not care too much about volatility. I've always thought, especially in the last 15 years, I've thought that volatility has been overemphasized. Of course, volatility is very important if you haven't got a long-term horizon. And the upshot of the volatility that there is that if you haven't got a long-term horizon, you shouldn't be investing much, if anything, in equities. But if you have got a position in which you can be long-term, if, for example, you've got a very decent income and you've got some capital and you're youngish, you can invest the capital for the long term. And then the long-term investor should invest primarily in equities. And the question for the long-term investor is, why not 100% in equities?
Well, that's a good question. Well, actually, before we go on to why not 100%, another question is, why not just invest in the index rather than being a value investor? So value versus index, or is that a false competition I'm setting up here?
Well, I don't rule. I think that there are lots of ways to skin the cat. I think that value investment is in the blood. You're kind of born with it.
Okay.
You could try to get better at doing it, but whether you are drawn in the first place to low valuations, often with a lot of pessimism built into what is an essentially sound company, where there's room for a nice surprise, rather than being drawn to what I call the other table in the casino, which is labeled growth, where there is optimism and high valuations, and if there are unpleasant surprises, a huge hit to the stock. Value investors are naturally drawn to the value table in the casino, but I think there are lots of ways to skin the cat, and I wouldn't be dogmatic about not investing in another way. I happen to think that value investment is, well, I don't just happen to think. Again, empirically, the evidence is that value investment tends to produce better, very long-term returns. And I think there are good psychological reasons for that, because it's a harder thing to do. It's harder to invest in a company that's got something going wrong with it, which is often the case if it's got a low valuation, than it is to invest in a golden company that is growing very strongly. Everything looks great, but the valuation is high. The first, when it goes wrong, which of course it frequently does, is more difficult to explain than the second. So I'm drawn to value investment, but I wouldn't put the dichotomy between value and index. I put the dichotomy as between passive and active, so active and index. So why not index? Well, David Swenson, in his first book, which was principally for institutions, called Pioneering Portfolio Management, he set out all the, I'm not sure if he set out the reasons to be active, but he certainly set out how at Yale they went about being active and in choosing managers. In his second book, whose name I've forgotten, which was mainly for individual investors, he said, don't try it. Don't try active management. And I think that's quite a reasonable, a reasonable position to take, because active management does require application and research and so forth, and knowledge, which the ordinary individual investor is not going to be in a position to do. But I do believe that an active manager who takes decisions in a reasonable way is far from the frenzy of Wall Street and the city, where there is a tremendous tendency for thousands of people to flock to their desks each day and focus very intently on what happened yesterday to markets and yesterday to earnings, and to do things all the time. I do think that if you can refrain from those kind of pressures, then the active investor is in a good position the majority of the time to outperform. There'll be long periods when that isn't the case. There'll be many active managers for whom it doesn't turn out to be the case over the long term. And so stepping back from that as a chooser of managers, I think it's possible, if you're an institution or in fact, if you're an individual, to choose an array of managers, might be in the form of investment trusts or funds, but to choose an array of managers, the majority of whom will outperform the majority of the time. If you set out thinking that you can choose managers, all of whom will outperform nearly all the time or all the time, then you're onto such a sure loser, and it's fatal, because it means that you will, after a period of poor performance, you will run for the exit. And I've seen this. I've been on the investment committee of an institution which I felt that the committee as a whole did not have a commitment to active management, were very highly intelligent people, but they were very skeptical for academic reasons, because it was an academic sort of committee. They were very skeptical about the ability of active managers to outperform. And so they were doing it almost, holding their noses. They didn't really want to be there at all. And so I recommended that they go passive, because I thought that they would be bound to worsen the position by being active but not really wanting to be active. They would sack the manager who'd underperformed for 3 years. They'd appoint somebody who'd outperformed for 3 years. There's an incredibly impressive and disturbing figures from people like Cambridge Associates and one or two other consultants, And roughly speaking, it shows this, that in a particular, I think it was a particular period, so it may be exaggerated by the period, which I think probably was towards the end of the 90s. But managers newly hired managers, underperformed the index over the next 3 years by something like 4% a year. Managers fired outperformed the index by a large margin over the next 2 to 3 years. Don't hold me to the figures now, because I'm not.
No, but the qualitative conclusion there is quite powerful. That
in other words, most choosers of managers, that's to say most institutions, get it wrong. And they get it wrong above all because they react to periods of underperformance instead of trying to rate the manager, which we've always tried to do in my years at the family office, and on the various committees I've been on, not on performance, because if you look too hard at performance, it infects everything else that you look at. The performance is an inescapable piece of knowledge, but we try to rate on people, the quality of the people, their approach, their process, not to denigrate process in the way that I seemed to earlier, because of course some process is necessary. And then environment, which is really important, and that is in particular the sort of small firm, big firm aspect, the cacophony of noise that you get in a big firm, which provides a pressure to do things all the time, and that you don't have in a nice quiet place. I mean, I think that's why, Omaha, Nebraska has turned out to be not a bad place to run money for one person anyway. And Henley on Thames was not a bad place for Martin Arbib to start Perpetual. I think there are advantages. I always wanted to run an investment business from a garage in Battersea. Because, well, I happen to have a garage in Battersea at the time, so that's why. But being out of the mainstream, I think, is a great advantage in investment. You don't want to be too close to the weeds.
Yeah, that makes sense. And in terms of your valuation process itself, I mean, could you sort of run me through how do you know a company is undervalued and it won't just stay undervalued?
Well, I'm no longer, that I'm no longer a practitioner, so correct, I'm very stale. but the method at the firm that I've founded, and at the previous firm, is all valuation based, and valuation can mean a number of different things. It can be the appropriate means of valuation can be something straightforward like price earnings ratio, price cash flow ratio, free cash flow yield, or it may be some of the parts, and very often some of our best investments have been some of the parts where there is a quite unreasonable discount placed on the collection of assets. We want to invest in our firm to invest in essentially sound businesses. We are not afraid of cyclicality. Many investors shy away from cyclicality. We think quality is very important, but quality not ruling out cyclicality. It's very important if you're investing in, let's say, a mining company, that you have mining assets which are of very high quality at the right end of the cost curve. So that was always a very important sort of precept when we were looking at companies in that sector. We want low leverage, not necessarily no leverage, and there will be some exceptions to that rule. But generally speaking, the one thing we don't want to do is to combine high leverage operationally with high leverage financially in the same company. Because if you're investing in a cyclical company with high operational leverage, I'm a great disbeliever in forecasting. We never really know what is going to happen. And I think the last 2 or 3 years have shown that in abundance. If you're investing without a clear idea what is going to happen in a cyclical company, you don't know when the cycle is going to turn in favor of the company. It's very important that it should have a balance sheet which is strong enough to let it be there in 4 or 5 years' time, whatever happens. And then the third aspect of quality is management. And we are rather skeptical about meeting managements, but rating the management is important. I mean, I think I would still sort of echo Warren Buffett, who said that if you've got a business with a bad reputation and a management with a good reputation, it's the reputation of the business which will survive. So the business is more important, but all the same, you can see managements which have been beneficial or damaging to their companies. So those are those sort of three quality criteria that come into our judgment, and then it is straightforward valuation based on primarily on history and current, but with, of course, some projections. And we do spreadsheets, of course, but in my firm, but we don't want to become a prisoner of the spreadsheet, which I think you can very easily happen. You plug in a number, it produces a whole lot of lovely numbers at the end, and you think you've got some kind of certainty, but you haven't. It's just been very easy to plug in a particular number that changes everything else.
And you mentioned not necessarily meeting management. Many people think the opposite, that it gives you an edge if you go and meet the management, and you somehow, by meeting them, you pick up a vibe or something. I don't know what you want to call it, that you can't quite capture elsewhere. I mean, what's your thoughts on that?
Well, I think that I liked your hesitation before vibe, because what else are you supposed to pick up from meeting management? You're not supposed to pick up any information from them.
No.
I mean, 40 years ago when I started, I think particularly in the sort of small cap world, I did have colleagues who went and saw companies in the States or wherever, and they probably did pick up more than a vibe. I'm not but anyway, let's not go further into that. But what do you pick up from management? The thing you pick up above all is their tremendous ebullience and sense of competence, because what senior executives are good at doing above all is spinning the story for the company. And so I became, when I was at Mercury, which is now, I left in 96, so that's 27 years ago, I was head of the US equity team for a time, and I used to go and see Walmart. I think I saw them 3 years consecutively. And you'd see in those days, you could get a meeting one-on-one with the CFO, sat in a tiny office, gestured towards his car in the parking lot, which was a battered old Ford. And I always came away feeling this is the Sam Walton cost-cutting ethos, and thinking that the stock was probably worth sort of 2 more on the multiple than before I'd gone. But I came to think that I had simply drunk the medicines, drunk the Kool-Aid, so to speak. I mean, the managements are very good at selling their companies. And there's a danger in going to a company and thinking that as a result of going to its stores, going to its factories, meeting its management, that you're an expert, and that you've suddenly got a kind of proprietary knowledge about this company, which enables you to take a positive view. After all, if you were to take a negative view, then in the long-only world, which I'm in, then that knowledge is wasted in a sense. So you want to be, there's a prejudice to forming a positive view about a company that you visit, so that you can demonstrate your knowledge of that company in your decisions. And so I became skeptical about companies, and there've been a few instances where this has paid off for us, and a few instances where it hasn't paid off for us. When we were invested in Microsoft, and we were also invested in Renault, and at the time, Steve Ballmer of Microsoft could not put a foot right. Everything he did, the market slated, and the stock was on a very low multiple. At the same time, Carlos Ghosn couldn't put a foot wrong. The rest of the industry was producing X models. He produced 5X models. The rest of the industry was in a sort of cost management phase. He was in a tremendous growth phase. Anyway, he couldn't put a foot wrong, and he was treated as a sort of saint. And I refer in the book to what I call the premature beatification of chief executives. There is a tendency to build these people up on a pedestal. It happened with a chap called Mike Thompson, who was the chief exec at Rentokil. He became known as Mr. 20%. Do you remember?
Yeah.
And because he produced 20% growth year after year. But we all know, really, if we stand back for it, nobody can do that. Nobody can produce 20% year after year after year after year. Jack Welch did it at GE, and it couldn't go on, but the market assumes that it will go on. So that makes me skeptical about magic being attributed to chief executives. And with that, with Carnell Skone, one of the reasons we sold the stock, and I'm talking about a long time ago, pre-2008, one of the reasons that we sold the stock was that concern that everything that he did was treated as being blessed, and everything that Steve Ballmer did, and we bought more Microsoft stock at that time, was treated as being cursed. So that's the caution about chief executives. But we've made mistakes on that front. I mean, in one of our biggest mistakes in recent years has been with Tesco. When the chief executive, when Terry Leahy retired after a long, very successful career, he left a legacy, which is often the case with chief execs who have been around for a long time, that was very difficult for his successor. In the last few years, I think there is a tendency of chief executives who've been successful in post for a long time to push a bit too hard. And the result of that was that Tesco's margins were at too high a level. There's a great book by somebody, Bevan, can't remember her first name, about Marks and Spencer. And there's a little anecdote about Simon Marks, one of the early members of the family who managed Marks and Spencer, who warned against margins which were too high, because he said if the margin was too high, either the quality or the service or the quality of the goods was suffering, and that was so with Tesco. The margin was too high. His successor, Phil Clark, came into a very difficult job. Now, Phil Clark said we can get back to, after margins had slumped, we can get back to 5.2% trading margins. And we gave him the benefit of the doubt, partly because we felt sympathetic to the plight which he'd found himself in, having had this huge reduction in staff, which there had been at Tesco's. The supermarket staff had fallen much faster than elsewhere in the industry. Everybody was adopting automatic checkout. And so there was a tendency to reduce staff, but Tesco did more of it than anyone else. And Phil Clark had to row back from this. Anyway, he said 5.2% trading margins is what we can do. And we accepted that. We put it in our spreadsheet. It produced a valuation that was attractive. But our own sort of back of the envelope work suggested that this was going to be impossible. And so that was a case where we trusted the chief executive too much. And that's a very long answer to your question about how.
No, that's very insightful. And I mean, this is sort of very contemporary. But what do you make of a CEO like Elon Musk, who seems to defy, the conventional approach of CEOs who are very risk averse when it comes to media? He's kind of gone completely the other way in terms of being very sort of public. He obviously has bought Twitter, but even before then, he'd be flippant, often seemingly flippant with comments. But interestingly, it generates a set of marketing buzz that ends up selling more product, you could say, or creates certain brand value that you wouldn't have otherwise. I mean, how do you interpret Elon?
Well, I mean, the companies that he runs are companies that we hardly look at, except as sort of reference points for things which we do look at. So Tesla, for the motor industry as a whole, because they're on supremely high valuations.
Yeah.
And I think that sort of goes with the management style, if you can even call it a management style. I mean, he's a visionary. He's clearly brilliant. As you say, there is a branding plus to kind of outrageous behavior. You could say he's a kind of Richard Branson cubed. Richard Branson used to do pretty outrageous things, and that was part of the branding. I think the point about branding is a very good point. That I mean, he probably, if he's thinking about it rationally rather than in a kind of in his sort of brilliant and visionary way, if he's thinking about it rationally, he may well think any publicity that I get is good publicity. Maybe, but I think that it's a sort of volatile style of management which is almost impossible to judge. And so whatever the outcome, I think it's extremely difficult for an investment manager to judge a company which Elon Musk is directly in control of.
Yeah, no, that's a fair point. And, we are talking about tech companies now, so I do have to unfortunately raise this to a value investor. In the last, 10, 15 years or so has been quite tough for value investors, where Growth stocks have done incredibly well. Value hasn't really performed as well on a relative basis. Why do you think there has been this sort of fairly prolonged period of underperformance of value versus growth?
Well, I think that with the benefit of hindsight, there have been two, maybe, well, now it's, I suppose, three periods for technology in that period. The first was when the earnings growth was in fact very strong and valuations didn't move a lot. And so the valuation, with the benefit of hindsight, and of course, there were plenty of people who had foresight, but we didn't. With the benefit of hindsight, one can see that those valuations, which appeared quite high, they didn't get any higher. They may have been justified by that sort of 5-year period of growth. But that has not been so in the last, 7 years or so, in which the multiples have just gone higher and higher and higher. And then I think it becomes difficult to explain in any kind of sort of reasonable theoretical way. It only becomes possible to explain in terms of how investors behave. And investors behave by getting more enthusiastic about things which are going well, including stock prices which are going well, and less enthusiastic about things which are going badly. And so momentum is a very powerful force until, unfortunately, it isn't. And then it's absolutely desperate. And so you have periods like 99, 2000. I mean, in that period too, we did extremely bad in the first quarter of 2000. I think, did NASDAQ go up 50% in the first quarter of 2000, something like it?
Yeah.
In 1999, I think we were 15% or so behind the world index. In 1998, we were 15%. I forget exact figures, but we underperformed by a mile. And then almost on the dot of the 31st of March 2000, it all changed. And then it's extremely painful for those who are still in those stocks which have been driven by momentum. So I think there's only a kind of behavioral explanation for that second phase of technology. And then in the last year or so, we've had the third phase, which is perhaps the beginnings of the reappraisal. And you see that particularly in the venture cap world, where valuations have fallen valuation is almost the wrong word to use, because when you get to valuation of a company that hasn't really got any revenues, hasn't got any earnings, then valuation is a misnomer. And you have to resort to other kind of reference points like clicks or some other reference point, some kind of item which is not earnings or revenue to explain the valuation. So you're in a sort of blue sky territory where there's nothing really to hang on to, and then things can fall a great deal. And I think that's the world we've been in.
I mean,
but actually, can I come answer your question more fully? Because the other thing that's happened in the last 10 years or so is that interest rates were falling. Of course, that is great for growth companies because the discount rate is falling. And so it became possible to look at companies whose earnings and cash flow were off in the fairly far distance and justify investment. And on the contrary, cyclical companies did not have that benefit. And cyclical companies and very often value companies are cyclical, were also faced by a period of relatively low growth. So I think that value had that sort of headwind, which is then confirmed and exaggerated by momentum. That's what I would say.
Yeah. I mean, there has been some work in the in academia around intangibles as an asset. There's been a lot of work around that in the last 5-10 years about how maybe when we look at valuations, at least when we look at things like price to book, especially in the service sector economy, we need to, add intangible assets, which in current accounting conventions get counted more on the income statement side as OPEX. It should really be CapEx or intangible CapEx, you could say. Now, of course, intangibles by their very nature are, less easy to define, but it usually involves some idea of networks, reputation, brands, intellectual property, and those sorts of things. I mean, do you think incorporating something like that is appropriate within a valuation context, or is that falling into kind of new paradigm justification?
I think it's a lot of it is new paradigm justification, because you're forced to refer to things to which it's difficult to give a sort of a direct monetary value which has there isn't a relationship with money, unlike price and earnings and price and cash flow and dividend and share price. All of those things are a relationship between two numbers which are a part of the same language. I think you're forced in, as you say, a new paradigm way to relate money on the one hand to something which is not in the same language at all, like clicks or I'm trying to think of the other things that are referred to, but you know what I mean.
There's brand value. Some people somehow come up with brand value for a company or something.
Yeah. And then those things are only as good as long as they last, they're fine, and then they disappear. So I think there's partly a new paradigm effect. But I would say part of what you say is absolutely fair. That, I mean, an awful lot of R&D is, of course, it's on the P&L statement, but in other times in another company it would be regarded as a capital investment. So I do think that some of that is fair. But even when you make those kind of adjustments, still the inequality in the market has got greater and greater. The gap between the expensive sectors of the market, the least expensive sections of the market, has got much greater. There's good academic work on this, the top decile compared with the bottom decile, that type of thing.
Yeah, and another question in terms of why values underperformed, or another explanation, I'm just thinking is there something around, since the global financial crisis, banks got hit quite hard in terms of regulations and everything, and so their valuations look very attractive, but their businesses have fundamentally sort of shifted compared to before GFC. And on top of that, you have energy companies, oil companies that have been hit by ESG and this kind of shift in their sort of business model and stranded assets and so on. So you have two sectors which may have gone through a structural shock, which has led to sort of permanently lower valuations, so they could be value traps. I mean, do you think that is another possible explanation, or am I groping around too much?
No, I think it's completely true. I think it's completely true of banks, which then by what date, I don't know exactly when, but by sometime through the last 10, 15-year period, had rectified their balance sheets to an extent where those sorts of problems were not very likely to recur, and they'd become prudent to an extent that it's not likely to recur in the same way in the near future. And but with energy, I think what was regarded as a pretty sort of out of the box kind of explanation for low valuations 10 years ago, namely stranded assets, that's become a very real thing now, that there are assets which they have which may turn out to be never exploited and therefore worthless. So yeah, that does explain some of the fall in valuations. But I think it's very hard, however much you take these things by one, if you add them all up, it's still very hard to explain why the bottom quintile of the market has departed company in relative valuation from the top. Because what's happened, in fact, is the top has got much more expensive than it has done even at times when it's been expensive in the past. And the bottom has been pretty consistently at the same level of valuation within a range, quite a narrow range, for the last 25 years or 20 years.
And earlier, you kind of posed the question of why not invest 100% in equities? Maybe it was rhetorical or not, but let me ask you that question. Why not just invest 100% in equities?
I mean, I do think it's a very good question, because if you are truly long term, then why would you not? And I think the answer is that none of us or most of us anyway, are not quite brave enough to do so, and that therefore, when you do something which you do without your whole sort of heart in it, when it goes wrong, which it's bound to from time to time, you are panicked into doing the wrong thing. When I was setting up the family office back in 1996-7, I spent a long time talking to other people about what to do. And one of those was a great guy in the States, in Ohio, who had run the family money of a steel company family. And he said, and it really stuck in my mind, he said, if you invest 100% and the market falls by 90%, and that's happened, then your $100 has become $10. And you may well say, I know it's mad. I know I shouldn't sell, but I've just got to make sure that I tie down this $10. I can't afford to lose another $5. I've got to. And so you sell knowing in your heart that it's crackers to do so, but you sell because you've just got to get safe. And he said, if you invested 10% in something which was not equities, cash or government bonds, then the likelihood is that if you have a 90% fall in equities, the 90 which you've got in equities becomes 81. But the 10 which you've got in bonds or cash is still 10, and it may be more than 10 because on the whole, bonds will do well when equities don't. And you've got a portfolio of them which is half in bonds and half in equities. And you are not likely, you're more likely to say, we've had this huge fall in equities, is agonizing, but I've got 10% which is safe in bonds. I can afford to let this 10 in equities continue to play, and we'll see what happens. And in 2008, I had a friend who was working for a US investment bank who did exactly what I've just described about the 100% person. He said, I know it's crazy, but I've got all this XYZ investment bank stock. I've got to nail down what's left. And so he sold right at the bottom in, I think it was March 2009. So I think that's why every investor needs what I call a cushion of comfort. And the comfort for some people temperamentally and because of their circumstances may be quite a small cushion. It might only be 10%. The comfort for another person may be in exactly the same circumstances, but a different temperament, may be a much higher figure. It might be 40% or 50%. But whatever the cushion of comfort, which will mean that when things go wrong, you don't react wrongly, that's the percentage that you need to have in things that are not equities, I think. And I think you can have two very rich people who behave in utterly different ways. You can have on the one hand, the guy who's made a huge amount of money from selling a business and who says, the one thing I don't want, the one thing I can't take is to lose any of this that I've struggled all my life to make. And that person needs to be very prudently, very safely invested. On the other hand, a person in exactly the same circumstances who's made a lot of money out of selling a business might say, I've got all this money, it's much more than I can never ever need, or that foreseeable next few generations will need even. We might as well maximize it. It's the parable of the talents, to maximize. And I think either of those are very reasonable emotional positions. But if you've got individuals involved, you have to recognize that they are people, not institutions, and they've got emotions. An institution, in a way, is easier because it's more objectively characterizable as long-term or not long-term. I've always thought, pension funds are just in an impossible position because they should be long-term. Defined benefit plans should be long-term, but they're forced by accounting actuarial rules to be very short-term, and they're forced to do things which as an individual you would never dream of doing, to push more and more into bonds, the lower bond yields go, which is exactly what happened. And of course that led to this thing that I'd never heard. I never heard of LDI before Mrs. Truss was Prime Minister. But it led to institutions trying to have their cake and eat it, like at Lloyd's of London, where you were invested, you were in business in the insurance market, but you also use those same assets to invest. Well, similarly with LDI, because it was all derivative based and based on margins and collateral and so forth, you could put up a very small amount of money to get a lot of exposure to a further decline in interest rates and have plenty of assets left to invest. And of course, that then goes massively wrong. That's a bit of a digression. But anyway, institutions, I think, can be more objective about their long-termness than individuals.
The other thing that I found also is even if an institution says they are long-term, I think they almost become short-term by the frequency of how often they have to report their returns.
Yeah.
So I could say I'm a 10-year institutional investor, but I report my returns every week or something, or even every quarter. Then suddenly you're managing to the reporting period rather than to your horizon.
I quite agree. I mean, we had very early in the life of my firm, we had a well-known name wanted to give us some money to manage, and that person wanted weekly performance figures, and I said, I'm sorry, you can't have weekly performance figures. At that stage, our funds were all measured, they were all priced monthly. For technical reasons, they're now priced daily, but anyway, they were priced monthly. And I said, you can't have weekly figures because I have a sort of foible, which is I ask once intra-month what the performance is. I have a pretty good idea because I see the stocks and I'm pretty close to it, but I ask once intra-month. I don't want to ask more often than that, because if it's good news, it makes you complacent. If it's bad news, it makes you neurotic. I don't need to know. I don't want to know. And you can't know more than I know. And so I'm sorry, you can't have weekly performance figures. And that guy went away, and I'm very glad he went away. It was in about 2007, because in 2008, he would have been on to us the whole time, saying, pointing to the thing which was doing worst, which was we held stock in RBS until October the 6th, 2008. He would have been pointing at that and just putting us off our stride. Of course, if he persuaded us to get out before October the 6th, he'd have been doing us a good turn. But but he would put us off our stride. On the whole, hyperactive clients who make their managers sort of doubt what they're doing are not helpful to their own interests. They hurt their own interests. And so I totally agree. Reporting too often is not a good thing. I think I quote in my book Jonathan Ruffer, who was once in conversation with a very sort of long-established British family, and Jonathan said something like, I take it you're not interested in quarterly performance. And the family said, no, we're very interested in quarterly performance. And if after the first 25 years it isn't good, then we'll be really worried.
That's a nice investor to have, a nice client to have. Yeah. Now, yeah, I did want to ask about certain types of investment styles that have become quite popular. One has been private equity, who kind of almost present themselves as value investors almost. Their idea being if they find underperforming businesses, then they come in using some financial leverage, but nevertheless, they come in, they change the operating model, change management, fix up the business, hold it for some number of years, then sell it on. So they almost kind of talk the language of value, and they also show very strong returns over the last, X number of years. But you as a value investor, how do you look at private equity?
Well, it's not something that I do or our firm does, but I've looked at it a great deal because I've been on committees where there's been a private equity commitment. I've seen and known plenty of private equity managers. The figures show that over almost all periods, the 5 years up to the end of 2021 would probably show something a little bit different, a bit more favorable to private equity. But on the whole, if you leverage the S&P, for example, to the extent that private equity is leveraged, then the leveraged S&P well outperforms the net returns of private equity. So I don't think there isn't any alchemy in private equity. You get a greater dispersion of returns. There are people who do it, have done it exceedingly well, people who've done it exceedingly badly. And so picking the first quartile or even the second quartile manager in private equity is hugely beneficial. But in the end, if you have a room full of 200 people and they're all trying to choose private equity managers, they're going to choose the average private equity manager. On average, they will have chosen the average private equity manager. So that dispersion of returns does provide opportunity. That's something serious. But it doesn't show that private equity is in some way superior to quoted equities. It is basically a question of leverage. And I worry about private equity for all sorts of reasons. I mean, I think that the fee levels are just too high. The fee level, the 20%, was originally fixed by the founder of hedge funds, A.W. Jones, in the early 60s, 1965, I think. And he adopted this 20%. By the way, without a management fee, just a performance fee. He adopted the 20% because he copied the fee which sea captains charged if they were taking a cargo around the Cape of Good Hope. Well, those captains were risking their ship and also their lives. If you look at all the wrecks at the bottom of South Africa, you see how many wrecks there were. The hedge fund managers and the private equity managers have been very, very lucky with this precedent created by A.W. Jones. And I think that percentage of the pie is just too big. It doesn't leave enough. It's not a sort of moral question that they shouldn't earn so much. It is a practical question that the people who own the money, the rest of the pie is not big enough to provide a decent return to the owners of the money. And I think that's shown even more sort of severely in the hedge fund world, which I have a strong view about. So I'm pretty hesitant about private equity as a whole. And I do also, but this isn't an investment thing, I do worry at the extent to which when things have gone badly, even scandalously badly in various industries, private equity has been so much involved. Sitting where I am in Kent, I've got coastline on two sides of me, and all that coastline is ruined by the sewage which has been pumped into the sea by a company which is owned by private equity. There are a whole lot of other industries in which private equity does not invest enough and takes cash out. And I think that's dangerous. And it's perfectly reasonable for the it's reasonably reasonable for the private equity managers to take advantage of the playing field that they're given. But I think it's something for governments to do something about, particularly probably in equalizing the tax treatment of interest and dividends.
Yeah. And you mentioned hedge funds as well. Is it the same issue with hedge funds, that their performance doesn't really justify those returns, or is there something else about hedge funds as well that concerns you?
Well, I think that there are so many things about hedge funds. I don't know where to begin, really. I mean, I think I've always regarded selling something which you don't own as sort of fundamentally flaky. You don't do it with almost any other bit of life. You don't do it. You don't sell a car you don't own, or a house you don't own, or a picture you don't own. So why should you sell a stock you don't own? So that's something I find rather sort of unsatisfactory about that. And I think shorting introduces all sorts of emotional pressures, which makes people very short-term act in a sort of counter reasonable way. If you have a short position, one of the disadvantages is that when it goes wrong, it gets larger. And so you're more or less forced by stop loss positions and by the nightmare of a position becoming just too large a percentage of the portfolio. You're forced to take something off it when it's going wrong. Well, that means you're selling something which is now more attractive. You're closing something rather. You're closing a position which is more attractive than it was when you put it on in the first place. And I think that kind of attitude can then stray into the long side of the portfolio, so that you find yourself buying things when they're expensive and selling things when they're cheap. So I think there is a sort of complicated intellectual flakiness about the business of shorting. But mainly it is that the fees are just too high. If you charge 2.20, then it is very difficult for more than a fraction of the hedge fund universe to produce a decent result. And they haven't produced a decent result, with the exception of a few. And I absolutely praise and respect, and so on, the few. But as with all managers, it's very difficult to know in advance who's going to perform well. You can see who has performed well, but it's very difficult to know that somebody who has performed well will continue to do so, or for that matter, somebody who hasn't is likely to do so. And so if large fees take an enormous chunk of the pie, then to switch the metaphor, you're rolling an enormous boulder uphill. Even in the long-only world, you're pushing a boulder uphill because the active manager underperforms, but it's a relatively shallow gradient. In the hedge fund world, because of the fees, it's a huge steep gradient. So that's the main reason. But a man called Simon Lack wrote a book called The Hedge Fund Mirage, and he totted up the gains made by managers over the years on the assumption that they had reinvested all their proceeds in their own hedge funds, and the gains made by the owners of the money. And he found, roughly speaking, that the managers had made, I think, $380 billion over the period since 1965. The owners of the money had made $36 billion. I'm now worrying whether it's trillion, but I think it's billion. Yeah,
well, the order of magnitudes, the relative,
yeah, the order
the
of
relativities are there.
The order of magnitude is 10 to 1, which interestingly is exactly, there's another little sum done by Terry Smith on investment in Berkshire Hathaway. And what he showed was that if you invested in Berkshire Hathaway in, I think, 1965 again, then you would have earned, and I'll put it in X rather than in specific numbers, you would have earned X. If you had instead invested in a hedge fund, and the manager had put all the fees which he earned back into Berkshire Hathaway stock, and the only asset of the hedge fund was Berkshire Hathaway stock, then at the end of the period, the owner of the money would have 1/10 of X.
Okay.
And the money manager would have 9/10 of X. Extraordinary.
Well, it's good to be a money manager, I guess.
It's good to be a money manager with a 2 and 20.
Yeah. Just coming back to the short selling, I mean, one case short sellers make is that they're able to see some of the errors companies are making. They're able to enact changes more effectively. They're able to discover scandals that others aren't willing to do. So they have an important kind of market efficiency rationale for that. I mean, do you think that's fair, or are they overstating
Well, I
their
don't
case?
see why they should be able to discover scandals more quickly than anybody else. They do, of course, publicize scandals more quickly than anybody else because they've got a vested interest in the short position that they have. And as to this business of price discovery, I think that is quite. I think that's a sort of extra chapter in efficient market theory. I mean, most of us probably are not great believers in efficient market theory these days, which is pretty much discredited. But one element of efficient market theory is that prices reflect known news pretty quickly, and I don't think you need shorters in order to make that true. A market will operate pretty efficiently if there are a reasonable number of market participants, some of whom are buying and some of whom are selling. And for every clever and well-informed buyer of a stock, there is also a clever and well-informed seller. So I don't think you need shorters in order to create efficient prices. And I'm not sure, I'm not an expert in this, but if you look again empirically at the experience of companies that have been very heavily shorted, I think you would see much greater price volatility than appeared to be justified by the fundamentals. And I think that probably is largely partly an effect of the short-termism of most participants in markets, much greater than was the case 40 years ago, but it must be partly the case of shorting.
And just the other aspect of short selling is the other side of who is lending the stock. It's the asset managers who make money through securities lending, which often can be very lucrative. And in many instances, we see with some of the largest asset managers, it's allowed them to offer like zero fees on some of their index funds, for example. So, I mean, what do you think about the other side of it, the asset holders, the asset managers who then offer their shares up for securities lending? I mean, do you think that's...
Well, I think they need to be careful. And a lot have withdrawn from securities lending, partly because there could be a counterparty risk, which I think is quite likely. You need a whole set of things to come together for a counterparty suddenly to be a risk, but you can see how it can happen, and then there'd be large losses in a business in which the gains are too small. You're picking up pennies in front of the thing. What is it called? The thing that does that along
steamroller or
the steamroller.
Yeah.
Picking up pennies in front of the steamroller. And so I think owners of assets should be very careful about their securities lending.
And you did mention Berkshire Hathaway, and reading your book, it made me think about, is Warren Buffett, is he a value investor or is he a quality investor?
I think he's the person who has confused the terminology, because he invests in Coca-Cola, for example. Well, Coca-Cola is not by any stretch of the imagination, a value stock in the sense in which a deep value investor talks. But because Warren Buffett is regarded as a value investor, it's become, there's been this new kind of generation of value investors who are not value investors in the old-fashioned sense, but they have much more emphasis on quality. So I think that it's a different type of investment from what I call value investment, which is closer to deep value.
Yeah, and in terms of your outlook, if you did have one for say the next 5 years for value investing, what would I'm assuming you think now is a good period should be a good period for value, at least versus growth.
I do. I mean, I think we've come through this long period in which interest rates were falling, and that has the effect on discount rates, which we talked about. Great for growth, not great for value. And meanwhile, you've had all the price movement, so that the prices of the value world are just remarkably low. I mean, we're not quite in March 2009 territory, but at the beginning of my career, I started investing in the early 80s. The sort of yardstick for what might be a reasonable valuation was a PE of 10 times. And now in my firm, all the portfolios have an average PE of around 10 times or less in some cases. And these are, as I say, essentially sound companies. So I think there's a tremendous valuation attraction in the value end of the market. And I think the dynamics favor value in a way which they didn't in the 10 years since the global financial crisis, with QE and interest rates getting ever lower until we reach zero. That was a very negative background for value. Now I think we're through that. We're in a different period in which inflation may well come down. My bet would be that it will come down quite sharply next year, but we're probably going to be in 4, 5, 6%. I doubt whether we're going to return to a 2% world very soon. And so interest rates are having this very awkward time, because even though they've gone up quite a bit, interest rates should be above the rate of inflation. Short-term interest rates should be at or around the rate, at or slightly above. Bond yield should be quite a bit above, and equities still return should be considerably higher than inflation. But long-term bond yields should be 3% or so, 2 to 3% above the rate of inflation. Well, how do we get there? That's a pretty painful process. So even if inflation comes down, I suspect we will see bond yields remaining at this level or going up, and that's a very good background for value.
Now, I did want to round up with a couple of personal questions. One is, what's the best investment advice you've ever received from anyone else over your career?
A bit of advice that I liked very much was given by my old boss from Mercury Asset Management days. He often used to say, in any kind of crisis, he would say, do nothing. And of course, it wasn't always right. In a way, it wasn't ever right, because there was always something you could do which would improve the situation. But the cleverness of it is that anything you were likely to do was likely to make matters worse. And another guy I respect a great deal, who was the chairman of the investment committee in Australia in 2008, told me that he'd cancelled the forthcoming investment committee meetings because he was afraid that if the committee met, they might decide to do something.
I like that.
So I think doing nothing is very often better than doing the thing that you are most likely to do if you do something. And it's the opposite of what the investment manager's driven to think, gosh, I've got to act. I can't just sit here doing nothing. I can't come to my desk all day and do nothing. And it's particularly difficult in a crisis to do nothing. But 9 times out of 10, the thing done at a moment of crisis is worse than the thing not left alone.
No, that's a fair point, and I think I'm sympathetic to that in my own experiences as well. Now, we do have some listeners who are young, leaving. They've finished their university degrees. They're about to enter the job market, or they're going to enter the job market later this year. What advice would you give to somebody as they leave university and enter the real world?
Well, if they're interested in investment, then go for it. And if they're not interested in investment, don't pretend that you're interested in investment, because it's a tough life. I mean, it has all sorts of privileges. It's well paid. I had a colleague who said it beats cleaning the streets. And yes, it does. But it's also very stressful when it's going badly, which it will for everybody from time to time. It's very stressful. Don't do it unless your heart is in it. And if your heart is in it, then go for it, is what I would advise. And then read a lot, sort of practice a lot, have a dummy portfolio, all that type of thing. The job market for investment managers is very tough. It's very hard to distinguish yourself. But if you can show that you've had the real interest and commitment for a long time, I think the fact that it's in your blood helps a lot. I've had young people come to me who say, I'm interested in a career in financial services. And I put them off, because I say, if you're as general as that, it means you don't really. It means that your mother has said that financial services is well paid, and you should get a job in financial services. So my advice, if you really want to do it, go for it.
Yeah, no, that's fair. And you mentioned read around a lot. And so in your case, what are some of the books that have really influenced you?
There's a book which is pretty much off the map. Not a lot of people would come across it. And that is a book about Peter Cundall, who is a Canadian value investor who was a bit of a mentor to me. And it's called There's Always Something to Do. And I think it's a terrific book. It's by a man called Chris Risseau-Gill, about Peter Cundall's way of investing, which was extremely brave. And as the title suggests, there was always something to do. One of the things he used to do was at the end of every year, in December, he would see which market had performed worst in the year to date, and he would then go and visit that market, and might then invest in that market. So he was always looking for things which have been awful and have the potential to surprise on the upside. And then I love everything Howard Marks writes, his books, but also his memos, which are just full of wisdom, particularly about risk, and especially about the risk of about upside risk as well as downside risk. That people can be too negative, and share prices can be, when a situation is bad, all you need is the situation turn out to be less bad than the share price suggests it is, for the share price to do well. Now, some people would say they're just not interested in that kind of thing. Growth investors would not be interested in things which are, but value investors are, by their nature, they are interested in those sorts of areas where there's something which has gone awry. If that can be repaired, then the share price is at a level at which there can be a tremendous amount of upside. So Howard Marks is very good on that sort of thing. And then, of course, Ben Graham and Warren Buffett's annual reports, those sorts of things.
Yeah, that's great. Okay, that's great. And your book is called Simple But Not Easy. There's a updated edition, came out last year. I read it on Kindle, but you can buy it in bookshops presumably as well. It's available in all the usual outlets. Presumably that's the best way for people to follow your way of looking at the world. Are there any other ways for people to follow you, or?
No, that's the only way. Thanks for the puff for the book. But that is the only way. I mean, the only thing I do at my firm now is to write a quarterly newsletter, but I think that only goes to clients. So I think that is the only way. Yes.
Okay. So definitely buy the book. And, on that, I mean, thanks a lot, Richard. It's been fantastic hearing your stories and your philosophy, and good luck with investing. And it sounds like the next few years should be quite bountiful. I hope.
Let's hope so. Well, thanks very much, Bilal. It's been a great pleasure. Thank you.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.